Investor Behavior Trends in Private Markets, what data from 2024 through 2025 actually shows. Investor behavior changes with economic conditions. It always has. What's different today is that we now have data visibility into private markets that didn't exist 10 years ago. Through SEC datasets, intermediary reporting, and market participation trends, we can now see how investors are actually behaving, not how commentators think they are behaving. Today, we're going to focus on what changed in investor behavior in 2024 and into 2025, particularly in private offerings, crowdfunding, and exempt securities. The first shift, risk awareness increased, not risk avoidance. A common misconception is that investors retreat entirely during uncertain markets. The data does not support that. What actually happens is risk repricing, not risk abandonment. Investors become more selective, more disclosure-driven, more valuation-sensitive, more focused on downside protection. This is visible across Reg D, Reg CF, and Reg A activity. Deal flow continues, but tolerance for vague narratives declines. The second shift, preference for transparency over hype. Across crowdfunding portals and private placements, offerings with clear financial disclosure, realistic use of proceeds language, explicit risk factor explanations consistently attract more investor engagement than high-growth but opaque offerings. This aligns with SEC disclosure theory. Information asymmetry increases perceived risk, which reduces participation. In plain terms, investors now reward clarity more than ambition. The third shift, smaller checks, broader participation. Average individual investment sizes declined slightly in late 2024, while total participation increased. This indicates risk spreading, portfolio style behavior, increased diversification. Rather than concentrating capital in one deal, investors are allocating smaller amounts across multiple offerings. This mirrors venture capital portfolio logic applied at retail and semi-professional level. The fourth shift, time horizon realignment. Investors are adjusting expectations around liquidity. There is greater acceptance that Reg CF investments are long-term hold positions. Exits are uncertain and event-driven. Distributions may take years. This is a sign of market maturity. Earlier phases of crowdfunding saw unrealistic liquidity expectations. That behavior has normalized. The fifth shift, governance and operator credibility matter more. Investor questions increasingly focus on leadership experience, governance structure, reporting discipline, and post-raise communication, not product hype. Investors understand that execution risk exceeds idea risk in most private deals. The sixth shift, education-driven participation. More investors are reading offering documents, reviewing Form C filings, understanding security types, comparing intermediaries. This suggests the private market investor base is becoming more sophisticated over time. That trend aligns with the SEC's emphasis on disclosure as a primary investor protection mechanism. Key takeaway: the private market investor of 2025 is not reckless. They are cautious, diversified, and increasingly informed. Deals are not failing because investors disappeared. They fail because they fail to meet higher standards.